Success in trading never comes from a magic indicator or a hidden system. It comes from emotional discipline and strong risk management. One emotional error can wipe out weeks of progress. Chasing a missed entry, doubling down on a losing trade, or revenge trading after a loss. Traders often think they just need one more tweak, one more indicator, one more confirmation. But the truth is, the issue isn't the chart. The issue is the trader. Today we're going to talk about the missing piece of the puzzle. The one thing that separates profitable traders from the 90% who struggle. That missing piece is trading psychology. Think of it this way. If your technical skills are the engine, then trading psychology is the fuel. Without it, you won't go anywhere, no matter how strong the engine is. In today's video, we'll cover what trading psychology truly means, how it impacts your performance in the markets, and 7 key rules that will help you master your mindset and trade with discipline. So guys, if that's something you're interested in, make sure to hit the like button to support our work and subscribe to our channel if you're new. I'll see you after the intro and disclaimer. What is trading psychology? Trading psychology is how you make decisions under pressure. It focuses on the mental and emotional side of trading and how your mindset, emotions, and discipline shape your actions and overall performance. It matters because even with the best trading strategy, you can still fail if you cannot control your emotions. Consider this common scenario. A perfect trading setup suddenly appears on the chart. All the signals indicate that the price will move up. You haven't seen such a perfect signal alignment in weeks. So you decide to go big on this one. You think, if I risk half of my capital and target a 1 to 2 risk to reward ratio, I can double my account in one trade. This feels like exactly what I need after all my hard work. You place the trade, and then suddenly half of your account is gone. The market moves against you and reminds you of a very important lesson. No matter how perfect a trading setup looks, you must always follow your risk management plan. There are many emotional mistakes like this. The fear of missing out pushes you to enter the market too early, only to watch the price move exactly as you predicted. But after stopping you out, closing a trade too early, only to see the price hit your target afterward. Doubling down on a losing trade or revenge trading. Now, enough of the talk. It's time to learn the skills of trading psychology to improve your trading success and avoid emotional mistakes. On this topic, we've put together 7 trading psychology rules to help you gain better emotional control, improve your decision-making under pressure, and increase your overall trading success. Rule number 1. Have a rules-based trading plan. A rules-based trading plan helps you make decisions objectively instead of emotionally. It clearly defines the conditions for entering a trade, where your stop loss and target should be, and how to manage your positions. Here's an example of a rules-based trading setup. First, identify a double top pattern and wait for the price to clearly break above this level. Draw a line from the highest close and wait for the price to pull back and touch that line. After this, the only thing required to enter a long trade is a candlestick closing above the previous one. This acts as our signal to open the trade. Place your stop loss below the lowest point of the swing low and set a target at 2 times your risk. Now, imagine that within the same trading setup, we choose to enter the market when it shows signs of a reversal, such as a long wick candlestick. But here's the question, would you consider this a long wick rejection candle? Some of you would say yes, while others would say no. And that is exactly what makes this setup subjective. So the second rule is this: make your trading rules non-subjective. To achieve that, we need to define our long wick rejection more precisely. For example, a candlestick qualifies as a long wick rejection if the lower wick is equal to or greater than 2 times the size of the body. Now let's test that rule. We have a candle with a lower wick of 9 pips and a body of 4 pips. Does it qualify as a long wick rejection? I'm confident all of you said yes. Unless you disliked your math teacher back in school. Because 9 is more than twice 4. And that's how you make your trading rules non-subjective, leaving no space for emotions or uncertainty in your decisions. This also ensures that your backtesting results are much closer to real market conditions. The more realistic your backtesting is, the more confidence you develop in your system. Accurate backtesting gives you reliable data, allowing you to evaluate your strategy objectively and make informed adjustments over time. Traders say, Rule number 3, stick to your risk management plan. Now, what is risk management? Risk management means protecting your capital while you trade. It's about deciding how much you are willing to lose on a trade before you even enter it. This way, a single bad trade doesn't wipe out your account. In simple terms, risk management is like wearing a seatbelt while driving. It won't prevent accidents, but it protects you when something goes wrong. Here are some examples of risk management actions. You risk only a small portion of your capital, typically 1 to 3%, on each trade. You set a stop loss, which automatically closes your trade if it moves too far against you. You avoid putting all your money into one trade or one market. Now here comes an important question. How much should you risk per trade? The answer depends on your risk tolerance, which is the amount of money you are comfortable losing when you face unavoidable losing trades. There are two types of risk tolerance to consider: risk per trade and overall capital risk. Ask yourself, what percentage of your capital are you willing to risk on each trade and still remain emotionally comfortable if the trade fails? Also, if you experience several losses in a row, such as 5 consecutive losing trades, how much total account loss can you handle without letting emotions disrupt your future decisions? Your answers will help you build a solid money management plan, and following that plan will help keep emotions out of your trading. If you risk more than you can truly handle losing, your emotions will begin to control your decisions. For example, if you risk 5% of your account per trade and lose 5 times in a row, your account will be down 25%. That is a substantial loss and can seriously impact your confidence. In that case, you may need to reconsider your risk management plan. But then you might ask, why not risk a very small percentage of your capital, such as 1% or even less? The reason is that the amount you risk also determines your potential profit. For instance, if you have a small account and risk only 1% per trade with a 1-to-1 risk-to-reward ratio, you gain just 1% on a winning trade, which may not feel rewarding after all the effort involved. The goal is to strike a balance where wins feel motivating, while losses remain manageable. If I were a beginner with a small account, I would likely risk around 2 to 3% of my capital per trade. That way, even with 10 losing trades in a row, I would only lose about 20 to 30% of my starting capital. Remember, risk management doesn't end here. It is the foundation that keeps you alive in the market. Rule number 4. Do not overtrade. Overtrading occurs when you take too many trades, usually because you are chasing losses or forcing profits. Always remember, quality is better than quantity. Stick to your trading plan. Wait for high probability setups, and don't let boredom or frustration make decisions for you. Maybe you've experienced a few winning trades in a row and start feeling unstoppable. You begin trading every small price movement because you don't want to miss out. That's greed, and it often ends with you giving back your profits. Sometimes, you're simply bored, the market is slow, so you place trades just to stay active. That is still overtrading, and it usually ends poorly because boredom trades rarely follow your strategy. Remember, more trades do not equal more profit. Every trade carries risk, and the more you trade, the more chances you have to make mistakes or lose focus. Rule number 5. Keep it simple. Many traders believe that using complex indicators, advanced tools, or multiple strategies will make them more profitable. In reality, simplicity is the key to long-term success in trading. A clear and easy-to-follow plan allows you to make quicker and more confident decisions. When your chart is crowded with too many indicators, signals, and lines, it becomes overwhelming. You start second-guessing your trades, missing opportunities, or breaking your own rules. At the end of the day, price can only go 2 directions, up or down. Even with your eyes closed, you would still have a 50% chance of being right. Keeping your strategy simple doesn't mean it's weak. It means it's focused. Simplicity helps you understand what you're doing and why you entered or exited a trade. Remember, your goal is to trade effectively, not to impress anyone with a complicated chart. So remove all unnecessary and pointless information and focus on naked price action itself. Rule number 6. Do not revenge trade. One mistake in trading often leads to another. For example, imagine you just took a large loss because you didn't follow your plan or ignored your stop loss. You feel frustrated and want to make that money back immediately, so you jump into another trade without proper analysis. That is revenge trading, and it usually makes the situation worse. Revenge trading happens when emotions take control after a loss. Instead of calmly reviewing what went wrong, you try to force a quick win to fix your mistake. By doing that, you end up breaking your rules again. This cycle can destroy both your confidence and your trading account. So whenever you make a mistake or break your trading or risk management plan, do not try to win it back right away. Take a pause. Step away from the screen. Give yourself time to relax and clear your mind. Once you're ready, journal your mistake. Write down what happened, why it happened, and what you will do differently next time. That's how you transform a loss into a lesson. Rule number 7. Manage your trade to reduce pressure. In this section of the video, we're going to explain trade management strategies that help reduce mental pressure, secure partial profits, and capture large risk to reward trades. This is all about what happens after you enter the trade. So imagine you've taken a trade in this scenario to benefit from a bull market, with your stop loss placed below the engulfing candlestick. A common approach is to target a strong risk to reward ratio such as 1 to 2 or 1 to 3. The issue with this method is that as price nears your target, you start feeling anxious that it might reverse, turning a winning trade into a losing one. And sometimes, that's exactly what happens. Or you might exit the trade too early, only to watch the price eventually reach your original target without you, leaving unrealized profits behind. So here are some practical trade management solutions. Ways to lock in profits while still allowing your trade space to run. The first method is moving your trade to break even. So how do you make a trade break even? When the price reaches your 1-to-1 target, close half of your position in profit. This way, even if the price reverses and hits your stop loss, you won't lose money because you already secured the same amount in profit. If the price continues higher and reaches your upper targets, you can achieve large wins with minimal emotional pressure. The second strategy is trailing profits. Trailing profits means adjusting your stop loss to a new market structure level as price moves in your favor. For example, imagine the same situation again. We've entered a long trade and expect the price to push higher. If the price breaks above structure and forms a new swing low, we can move our stop loss from the original level to just below that new swing low. By doing this, we lock in profits and prevent the trade from turning into a loss. We repeat this process until the price reaches our higher timeframe target or reverses downward. For instance, if price breaks above a new high, we move the stop loss below the most recent swing low. This process continues until the price eventually pulls back and closes the position with a significant win. So guys, that's it for this video. There's a version of you ahead, stronger, wiser, more disciplined. And every single day, you're getting closer to meeting that person. If today pushed your mindset forward, hit like, and if you're new here, subscribe and ring the bell to stay connected to your growth. Your time is coming, maybe not today, maybe not tomorrow, but when it does, it'll make sense why nothing worked before. Keep going, don't rush the process, trust it. I'll catch you in the next video.